All right. Well, good morning, everybody. This is Tony Frazee. I'm the benefits specialist over here with Art Jetter. Welcome to another session here with us. Today, we are pleased to have Mr. Tom Stein with us from ATA America, going to be joining us for what I'm sure will be a very informative session. Did want to mention here, we're going to go over a lot of materials, but before I turn it over, just a quick reminder. We want to answer any and all questions you may have, so certainly feel free to type those in the chat box. We'll make sure to get your answers here before we end today's presentation. With that, I'm going to turn this over to Tom. If you want to go ahead and get us started there, sir.
You bet. Thanks, Tony. Wanted to say happy Thursday, everybody. We're getting close, and over the next 45 minutes or so, we're going to review some interesting stuff that hopefully will stick with you for longer than this week. Today, we're going to cover a couple of quick things about level funding in general as a precursor to getting into something that is a little bit more weedsy, but helps out in certain situations for clients. So the broker should be able to present this in a way that in these situations gives them a better option for the plan cost for the small group. But a bit on something else real quick. Why are you sitting on a call, listening to a voice from a speaker talk about something? My name's Tom Stein Jr. I'm with American Trust Administrators. We are small group level funding. That is all we do. We do it pretty darn well. We've been doing it for a little over 50 years now, so we're not also Rands. We are the, if not the oldest, I don't know who's older than us in the country. So jumping in off the bat, what we're going to cover is level funding basic parameters to start with. Now, whenever you're meeting with your clients, some candidates or some clients are good candidates for level funding. Some of them aren't. What we're looking to do is help a specific subset of the small business community and then put them in a place where they can win year after year. Now, when you're looking at small group level funded programs, you really need to change your time frame. You're not looking for the solution for next month or just this year. You're putting together a program that is a little bit longer term. But with that, you can do some work up front to save yourself some time for the ones that aren't going to work. These are the characteristics right here of groups that aren't going to fit with level funding. And these are broad strokes. And you can always call Tony and he can kind of give you a general idea with some basic information before we do the more work for level funding. Because as everybody knows who's done level funding as opposed to fully insured, it's more work up front. No doubt about it. It's more work to get them off the ground. So if you can save yourself some time by saying this group isn't a good fit or this one is, you can really be a little bit more targeted in your labor. So the big no-nos are the big ones that doesn't fit for client-wise. Groups that are on the fringe in terms of economics, if they're really on the bone and they really need to cut costs, they've got big layoffs coming up, not a good fit with level funding, right? If they terminate off anniversary or if they don't commit to a year, not a good fit. If they have a really incredibly sick group, not a good fit. If you look at those couple of characteristics, you can get rid of about 25%, 20% of your clientele, and they're not going to be a great candidate for level funding with us or really with anybody else. Now, when we talk about ATA, briefly, like I mentioned, we've been in business for over 50 years. We're family owned. We are small group. We call it medium size. We go up to 100. We do self-funded with stop loss and monthly aggregate accommodation, which is a fancy way of saying level funded. We go down to 5, and that's that. There's a couple of other slides here about what we do that's a bit unique. I'm trying to make this, as Tony asked me to make this more informational than pitchy, so I'm going to make this as informational as possible. A couple of pieces on this slide, though. As you expand your level funded book, these are going to make more and more sense to you because there's nickels everywhere in this industry. Now, the trade-off is you can either go super simple or you can go more complex. The more complex you go, the more it's custom tailored to a single client or a single type of client, but the more savings you can pass forward to them. The simpler it is, in general, the more expensive it's going to be for your client. So the biggest line you've got is fully insured to self-funded. Fully insured is super simple. Think Blue Cross and Blue Shield, but it is much more expensive. Level funded is more work, but in general, you can save them money. Now, as we roll through these other options, and these are things that ATA has, but other carriers have this as well. You have different PPOs you can play with. Now, from your business, you can look at that and say, all right, I've got in my area, I've got these 5 hospital systems. This PPO has all 5. This one has 1. So if you're looking at your client, you can say, is it okay to go with a narrow network and we can save a couple dollars? Again, it's a little bit more complicated, but you can save more money, a little bit more work up front. On the PBM, all of them have access to the same numbers of pharmacies, more or less, but you can get more complicated with how they prescribe or assign the classes of drugs. So what is a tier 1, what's tier 2, what's tier 3? Again, it's more work because then you have to go through and see where the drugs are, and that's something that we help with, and our sales team helps with that as well in the PPOs. HSAs, you should know about at this point. Dual and triple options, again, custom tailored plans to come to your clientele. A little bit more work, but you can save them money. And that gets down to what we're going to cover today, which is reference-based plans. Folks, they are more work. I'm not off the bat. They are more work. You have to do a little bit of culling of your leads. There's only certain situations that they work in, but there's a history here of how we got from the general market to where we are currently. And that's what we're going to cover today. And that should help you when you're talking to your clients, the people you care about, the people you take care of, should help you walk them through where and how and why RBP can be effective. So I'm going to bounce slides here. All right. If you'll bear with me. Any questions so far, or what questions do we have? That's a broad strokes setting of the table for what level funding is and what the market looks like, and really just trying to highlight that everything in our business is a trade-off. There's no silver bullets. Anybody who's promising you one, well, they're probably not telling you the truth. There's trade-offs to everything. But what questions have popped up so far? I'll give everybody a quick second to type them in, if there are any. If not, then I am an incredible presenter, and I will take the compliment. But all right.
All right, Tom, I don't have anything here yet showing, so I'll leave it up to you if you want to give it just a few more minutes or a few more seconds here. And but nothing's showing so far. I'll let you know if it does.
Well, I'm gonna take a hard sip of coffee, Tony, and then we're gonna bowl forward. All right, a brief history of payment. And folks, Tony asked me to curtail this. We have done this, the information we're going to cover today. I've done it in a 4-hour CE course a myriad of times. So I'm going to go real quick. We curtailed it down to about 40 minutes. And we're going to go through this, and you're going to get a history of not just RBP, how we got there, but also kind of how our industry has evolved, which, you know, you got to know the history of what you're doing, or else you're kind of subject to new history, if you will. All right. How health insurance started in America. The big things that we have to keep in mind. The original system, it's arguable. Most people would contend that the original system started during the railroad boom, where rail workers were given access to healthcare via the trains. And we're based out of Kansas, and a lot of those came through Topeka, Kansas. And that was the first type of health plan offered by a company was offered by the trains that brought everybody to Kansas, oddly enough. And this was a way for those hospitals, Stormont Vail in particular, to expand as they had steerage. Now, that steerage term is something we're going to talk about here off and on for the next 30 minutes or so. It also set it up where the unions would pay a percentage each month of their paycheck, and they had access to that in case they had a heart attack or lost a leg, which was a lot more common back in those days. And health insurance more or less limped along from that period to World War II. Now, there's a couple of things that we can cover in that interim, but for the sake of truncating it, World War II is when it really popped out. World War II, as everybody on this call knows, I'm assuming, for any of the millennials out there, it was a big war, and I'm poking at you, and I apologize. It was a big war between most of the European powers, and America completely industrialized during that period. And FDR, in his infinite wisdom, came out and said, you can't compete for labor using price. Well, the American spirit is always one of innovation. And so what they said is, we're going to use this little known piece, which is health insurance through the employer. And it's considered a benefit, not a wage. And that was ruled on during World War II. And as that happened, a guy named Bill Kaiser, Kaiser Permanente fame, if you guys know that name out there, came up with the idea to recruit labor to his West Coast production facilities, utilizing incredible employee benefits of healthcare and free births to his workers' wives, spouses, and families. And that allowed him to recruit a lot of people. Other people seeing that expanded it. And from then on, we had an employer-sponsored health program in the United States that has grown. At first, it was a very high trust system, and that gave rise to a system called indemnity. We're going to get back to that. So originally, at this time, people are purchasing a health plan where they are buying protection from the massive things. Think about losing a limb, losing a leg. It has evolved to where now people have access to the health plans just to get access to go see a doctor for the sniffles, right? It has become all encompassing as people sought to enrich, and I'm using that term in all of its colors, enrich themselves, the plans, their employees' lives. It has grown. All right. It's no longer just for the lopped off leg. It's now for everything. So what are we selling as a group? And this is a little bit of a market to message match. There's a line that I really love, which is, we are taking the probabilistic and making it deterministic. Or to say it in another way, everybody knows that there's a certain percent chance that their house is going to burn down. Insurance allows the people to know that for a very small amount, they know their house is going to get rebuilt. It allows people to sleep at night. It's the same thing on the human body. It's everything else that's more complicated than it's window dressing. That's the psychological thing that people are buying. They want to be able to know that at the end of the day, if I have a heart attack or little Billy needs to go get a appendix removed, it's going to be taken care of. All right. This allows us to take the cost of certain conditions and aggregate them. And that's a fancy word to say we're going to put them all together and then split them out by how likely we think it is and how often they actually happen. And that right there is the basics of risk and the basics of insurance. I'm assuming most people on this call already know that that's really what we're doing. Now, why is it so hard? Why is it that it's a complicated business? Well, the business is complicated for a couple of reasons. The primary is that we have Milton Friedman got a Nobel Prize for identifying this. We have a third-party payer problem in that, and I'm not saying there's a solution either. Somebody else is doing the aggregating and therefore paying for the big claims that come in, because You, me, and everybody else can't afford to pay for a heart transplant out of their pocket. But if you aggregate it all together, it's not that big of a deal. So because of that, there's a difference between the consumptions of care and the actual availability. It's called a perverse incentive. So if you want to think about this in a way that makes it simple to understand, if you go to dinner with your buddy, you order a burger. If you go to dinner with your boss and he's paying, you order a steak. There's a difference there. It's somebody else's money. And that right there is taken to an extreme whenever things become faceless, or whenever people see the large insurance companies, they think it's somebody else's money and there's very little self-control in terms of consumption. And that happens also on the doctor's side. The first level problem is what we just identified, right? That the consumer no longer is paying for something. And so because of that, the little tweak in your knee that doesn't really bother you becomes something that you get taken care of. So it leads to an expansion in the consumption of care against a model where it didn't exist. And that's fine. We can deal with that. The second, that's a little bit more nefarious, is that providers see the difference between the two. And this is not all providers. And again, most people are very good people, but a small percentage of them will go out and say there's a difference between who is consuming and who is paying. So I'm going to upsell, if you will, or I'm going to make small problems seem bigger to expand my revenue system, right? So these are problems that we've addressed as an industry. These were the solutions that popped out. We had the need, or the pre-certification process came out saying, no, if you're going to deliver something that's really expensive, another doctor has to say that that is actually validated, right? If we had another piece is, how do we change it to make it more of their money? That's why we came up with co-insurance, so that a percentage of the bill is still on their hook, and they value that money more aggressively than they value somebody else's. And it's not on the slide. There's another piece that really did come about, which is the expansion of ERISA and the ability for employers to pool money to take care of their troops, so that, yes, it's still your boss's money in the dinner example, but your boss is at the table with you. So you're a little bit more judicious in your consumption or what actually bothers you. Now, this did lead to additional issues, which came with additional solutions. The first model that we were describing there is called indemnity. And for anybody who's been in the business for, well, as long as my father has, then they're familiar with indemnity. And indemnity is a model that is very high trust. It is a model that says you consume the care, we cut the check. Boom. That's it. Now, whenever you have actors that are very high trust, that can work. But what happens with most things is that a few bad apples, I call them, I'm going to poke here, I call them the Wall Street types, come in and say, there's an opportunity here to really expand our penetration by doing a couple of things. And that really led to the shrinking of indemnity, because the trust started to erode. And you can kind of see how it was controlled and how it was played in there. In general, you had a lot of these indemnity programs run through fraternal organizations, again, trying to use social groups or affinity programs to keep people more honest, right? Now, this led to the other side of the equation, which is HMOs. This was the next solution of types. Its big value was, we're coming out and we are going to allow for the hospital to take all of its fixed cost and then spread load it across the entire pool of people who are in that community, right? We tried to flip the model, and it worked fairly well for a while. And what it allows is for a hospital to say, we've got 50,000 people in our community. They're going to all contribute X dollars. That covers all of our operating costs. And then we can put a little bit of a buffer on there so we can insulate ourselves versus downturns. Okay, that makes sense. And that worked fairly well for a while. There are a few HMOs that are still out there, and a few actually indemnity plans that are still operating around the country as well, for that matter. But it ran into a big issue, right? And if anybody on the call remembers kind of what stopped the HMOs, yeah, feel free. You'll get a gold star. That's a call. Anybody remember what really hit the HMOs and what pops to the front of your mind whenever you think about them? Tony?
Got nothing on this
Okay.
end.
All right. So the HMOs ran into a big situation where the lead times on the delivery of those care or that care became exorbitant. And again, we talked about the Wall Street type. That's how they ended up controlling cost. If they have this model that works fairly well, and the Wall Street types, and I got to come up with a better term, but everybody gets what I say when I mean when I say that. They came in and they said, all right, we've got a system that's running. It's making 5% a year in profit to improve the system. What if we slowed down the delivery of the really expensive stuff? Well, what that does first level is it turns that network of payables into cash. But that wasn't enough. And so what they ended up starting to do is elongating the lead times, and then also taking those extremely high cost procedures and putting a pre-certification model on it that was egregious, right? So the market responded. Okay, HMOs have been Wall Streetized. What's left? What's next? That came up with probably the primary player in the existing model, which is the PPO. And the PPO says we're more or less going to have an indemnity program, but instead of having it where we cut the check to everybody, it's only the providers that we trust. Again, we go back to a trust-based system. So if we trust you, then you're going to be able to come onto our PPO, and whenever our members come in and consume care, we're going to say that bill is right at a rate that is discounted because we provided steerage to you. So the hospital gets a percentage of the steerage or the value that they had in the HMO, which again, they're trying to normalize or level out their revenue cycle so they can pay for everything. The plans get a little bit better price because they are providing that steerage, and also the trust level goes back up because you're not taking everybody back into this network. You're only taking the ones that you can trust. And that has worked moderately well for a number of years. Now, this provided steerage through network access limitations, or saying you can't go everywhere, you can only go to the ones that are inside of the network. This provided a couple of other pieces, but it was really cracked. It's not fully broken, but it was really cracked during the ACA times. So before the passage of the ACA, what health plans would do is they would say there is $1 million max on the amount of care that any one of our members can consume. And for the sake of this conversation, we'll say over the course of a year. And so that put a bit of a constraint on the hospitals for maintenance care. Now, with the passage of the ACA, that went away. And so what has happened is that the cheap stuff, or the hip replacement, knee replacement type of care, has stayed roughly the same price at hospitals. It has gone a little bit up, but it's pretty stable. The extremely expensive chronic things have gone through the roof, where the rate of $1 million plus claims went from extremely rare to something that you have to consider for stop loss carriers on probably a weekly basis, right? Again, we're losing a little bit of the trust inside of the system because the incentives of the third party payer problem still exist, right? Again, some of these problems are non-fixable, but we can only seek to manage them. So the PPO managed them by only bringing in trusted facilities providers. Indemnity tried to manage it from the hospital standpoint only, or it was the HMO, and the Indemnity tried to manage it through we trust everybody to be a good actor. And there's always a couple of people that ruin it. Now, what are the other options that are out there in the market? Well, there's really two that are gaining traction. One is direct contracts. And a way to think of this is reducing the penetration of the PPO to extremely limited, to only the people you trust, but it is extremely geographically limited. So EPOs are only in one town or only in one metropolitan area. And it provides, again, you go back to a little higher trust system, but it's a trade-off. You can only market in this one area, and when they go out of network, the claims costs go way up, so therefore the cost to the member goes way up. That is the first of the two solutions that are really shaken. The second is what we're talking about here, which is reference-based pricing. Now, reference-based pricing is kind of turning the cost structure sideways. Historically, on indemnity, the hospital decided what something cost. And that model stayed around through PPO and EPO for that matter. And the hospital says, this costs $100,000. In indemnity, the provider strokes a check and says, thank you very much. In PPO, the provider says, well, I give you a lot of steerage. I want a 50% discount on that. And so the PPO, it started off as a $50,000 check, and the EPO, for the sake of math, we'll say is a $45,000 check. Well, when the Wall Street types got a hold of that and realized, hey, they'll pay 50% of whatever we tell them, they just increased their prices. That's it. They took the $100,000 knee replacement and made it $200,000, and then we're paying 50% off of it. What RBP does sideways is it says, no, we're not going to pay you 50% of what you say it costs. We're going to pay you a percentage more than what you take from your largest customer as paid in full. So the largest customer is the government. For that knee replacement that they say costs $100,000, the government pays them $30,000. On RBP, it depends on the plan, but with ATA, it's 150% for facilities. Different players have different levels. What RBP does, it says, all right, you took $30,000 from the government and paid in full. We're going to give you 45, and that's going to be square. And you can see that there's a difference between that 50 and that 45. All right. That difference is the price savings that you're giving to the client. But realize this is not a panacea. All right. You can see how it controls cost and how it also provides greater transparency. But you're going to run into a situation where the hospitals are not going to sit there and accept it at carte blanche or take it laying down, if you will. So what's the value to them for taking it, right? What do they get out of it? What do the hospitals get in terms of a win on this program? And Tony, do we have any questions so far?
No, pretty quiet right now here, nothing yet.
Okay, great. So the next piece is, what do the hospitals get, right? What are the upstream benefits to the hospitals? And what are they giving up for that matter? Well, the upstream benefits are really time frame and simplicity. Everything has gotten so complicated inside of our program and products that allowing the hospitals to just have a flat rate for it allows them to do what they do best, which is deliver care, right? They also get paid very quickly. There's no contracting. It's all done immediately, right? That's the value to them. The problem is that hospitals have gotten so complicated themselves, they don't know how much things actually cost. Whenever they went from a indemnity pricing model where we know we can make X on this, and they changed their prices to try to take advantage of everything, they've lost the plot, so to speak. That's why you see $40 ad bills, right? And you think I'm joking, you see them every day. The reason why they do that isn't because they want to charge $40 for that. It's because they don't know what anything costs anymore. And so with that, it simplifies with RBP. All right. What do the hospitals do when they don't like it? Well, that is the question that really gets popped up from your average user, right? We know that the business owner is making a decision saying we've got $100,000 for employee benefits this year. Rates went up by 8%. I got to do something, man. I'm not making another 10 grand this year. How can we adjust the benefit package so that we stay in line? So they're getting a lower cost, but there's going to be noise that comes from the members over time. It's not guaranteed to happen on every plan, but it will happen in general. And that is from denial of service and from balance billing. All right. We're going to address the first one first and the second one second. Denial of service is where a hospital will say, no, we're not going to take that patient. And they can do that if it's non-emergency. All right. And that is their prerogative. And that is their first kind of line of defense for the ones that either don't want to take RBP at all. And this goes back to where Tony can really help you. Those hospitals tend to be one of two things. Either the only hospital in town where they say you play our tune or you don't play at all, or university hospitals who say we are entitled to more than you're paying. Okay. So from the broker standpoint, when you're looking at your pool of potential clients for RBP, what you really want to do is say, these are the clients that are in metros with one hospital system, probably not the best play for RBP. These have multiple, great. Let's jump on this and let's offer RBP to these guys because there's multiple facilities in town and they're much more likely to accept the RBP. And that's kind of how you get through the denial of service. On our plans, at least, you can call into our customer service troops and they will direct care to people who have accepted RBP reimbursements from providers and facility standpoint to kind of answer those questions as they pop up for access. The number two is the scarier of them, and that is the balance bill. Now, balance bills are really scary to members because if we go back to the psychological piece, they're paying a percentage of their cost, and what they're buying is the not to worry. What RBP does, it says, well, you don't have to worry, but it might get bumpy. And so when you get calls from the clients, realize it's not really about the bill. It's about you showed them a little bit more of the dragon, so to speak. The hospitals, the doctors are great, but they can be Machiavellian and aggressive in their billing as well. And that's why members get upset with the balance billing. It's not necessarily because the process isn't going to be taken care of. It's because you showed them something that they thought they could put away. With balance billing, the members then tell the carrier about it or us about it. And we go to work and we say, look, this is, you accepted from the government. It's at this price. We paid you 50% more in the example. What's the issue? And at that point, most of the balance bills go away, but a certain percentage do not. And just to frame this, the balance bill rate is somewhere around 2%. So 1 out of 50 claims get balance billed. And of those, the vast majority of those claims are settled at the initial price. Whenever you respond to the balance bill for the facility, most of them say, all right, that's fine, we'll take it. The ones that don't are the ones that you hear horror stories out there about. And folks, if you don't set the table with your client, these become a problem. You have to let your client know up front, this is an RBP plan. It can get bumpy if the facilities want to take more than the plan deems is fair, right? That's kind of a decent way to think about it. We'll go back and forth, and we'll come to an agreement on the plans of, all right, you wanted, we cut you a check for 45,000, you want 60, we're ways apart, let's come to an agreement, and we end up settling at 52, right? There's, as soon as you get the adults in the room to where you can say, what do you want? How much do you want? And we can come to an agreement, it becomes a lot easier. But the scary part is, again, the trust side is the members have to trust the plan to go on their behalf and take care of it, right? That's the scariest part of RBP, is not the actual process, is the fact that you're kind of showing behind the curtain to the average member that hospitals can be tough to deal with. And that is an uncomfortable realization for a lot of folks. So, brass tacks, long and short of this presentation, what does RBP do? Where does it work? Who, what, when, where, and how, right? Who does it play for? Plays for clients who have decent health, who are in metropolitan areas or areas with at least 2 hospital systems. All right, that's the who. What does it do? Provides a really simple, transparent pricing model to both the plan owner or the business owner and the hospital and the facility. You take X from the government, I'm going to pay you 50% more than X on the facility, or 25% more than X to the doctor. What else does it do? It provides a very quick payment system, pays to the hospital quickly, they get their money, everybody's moving on with their lives, right? Who, what, where, when. These plans you really want to kick up at the beginning of the plan year with level funding. You have to be on a 12-month contract. There are ways to unwind RBPs if it really doesn't work in an area. It's much more work. It's better to do the pre-work up front, which is only to work in ones with multiple hospitals. But if you want to unwind it, there are ways to do it. And the why. Well, if you guys can't tell, I love this business, right? The why is, from a business standpoint, is it cleans everything up. It makes it simple, right? The more complicated we make things, the fewer of us are going to be out there that understand everything. And it is super complicated right now. So let's clean this monster up and make it simple. That's one. Number two, and why you're probably going to sell it to your clients, are the clients that need to reduce their cost. This cuts their cost, full stop. RBP is a more affordable play whenever it's put into place than PPO is, right? When the state of North Carolina went and looked at doing RBP for all of their employees, and don't quote me on this number, but I believe it was at 180%, which is very aggressive. They were going to save the state somewhere in the order of $40 million a year in healthcare cost. That's a big chunk of cheddar over going with the PPO, right? So there's a massive amount of cost reduction that's available. That's what you're going to be looking at for your clients, are the ones that either they had a really tough time with the hospital and they say, you look, the whole model is kind of screwed up, I want to simplify. And that's a rare bird. But the much more common bird are the guys that are saying, I really need to take care of my troops, but I am out of cash. How can I cut my cost and still take care of my people? And that is the majority of business owners. The majority of people care about the people they work with, that work for them, that they kind of time travel together with or work together. So that's the brass tacks of RBP. I kind of covered that in a moderately quick way. I am a huge fan of RBP in certain situations, and in certain situations, I won't play with it. Like Olympic Peninsula, Washington is a terrible area for RBP. So if anybody out there is in, Port Angeles on this call, don't play with RBP up there. That hospital system's tough to deal with. With that, Tony, how'd I do? What questions do you have?
No, I thought everything was excellent there, Tom. A lot of information there. Kind of a quiet group overall here, but give it a little bit here, see if anybody has any late straggler questions here. Let's see, don't need that. I know one thing, I wouldn't mind getting a copy of this presentation from you there, Tom, because I know there's a few people that were not able to attend today's session that would certainly love it. I know that. Let's see. There we go. All right. Again, anybody has any questions out
One
there, don't be
question.
shy. Please go ahead and type those into the chat or question box for us. We'll make sure to get answers for you. In the meantime, here, just again, want to thank you for everybody who did join us on today's call. Certainly enjoyed the presentation. Tom, thank you for being the co-pilot here, if you will, for today's session here. Always good. Let's see, just checking to see if we have anything else there, Tom, before we
I had a
kind
I had a question here pop up, and this is one that a lot of people ask. Does RBP reimbursement change by state? And the answer to that is kind of. The ability to place RBP changes by state, and that's kind of a proxy for it. So in states that have very high costs of care, i.e. Alaska, RBP is not a great fit unless you run it at a much higher reimbursement rate at baseline. So you can play around with that. And I'm just using Alaska as an example because it is the extreme outlier where the average RBP up there, I believe, is 250% or 60% higher than the lower 48.
All right, perfect. No, I appreciate it. Let's see, just again, thank you for everybody joining us for today here. If there should be any other questions, if we need to look at getting illustrations if you're working clients and that, certainly feel free to give us a call. As you can see the number there on the screen, the 800-228-0008, or you can actually email me over here at health@jetter.com. Been my pleasure, my honor, Tom. Thank you very much for co-piloting today's session. As I don't see any questions at this point in time, Tom, I'll go ahead and end the session there, but I want to wish everybody a good, safe holiday weekend. Again, thank you very much for joining us today.
Thanks, Tony, and enjoy the ham.
You too. Take care, sir.
Bye-bye.